put your favorite sports team front and center. Captain T's Upholstery is who to call. 352-369-1810. That's 352-369-1810. Or stop by their location, 5030 South Pine Avenue in Ocala, just past the drive-in. And of course, don't forget to visit them on the web, CaptainTUpholstery.com.
The very best in quality is Captain T's Upholstery.
The opinions expressed on the following sponsored program are strictly those of the host, guests, and callers, and not necessarily those of this station, its staff, management, or sponsors.
Keith Singer is registered with and securities offered through Investacor, member FINRA SIPC. Investment advisory services are offered through Singer Wealth Advisors, Singer Wealth Management, and Singer Wealth Advisors are not affiliated with Investacor. The opinions and recommendations contained in this broadcast are those of Keith Singer and Singer Wealth Management and not of Investacor. Past performance is not a guarantee of future performance. Upon liquidation, your investment may be worth more or less than its original cost. The investments discussed may be suitable for only some investors.
This is Prosper with Keith Singer. Every day, Keith brings you innovative strategies and world-class investment products to help you secure your financial future. Mr. Singer has appeared on CNBC's Closing Bell. He's been quoted as a financial expert in the Wall Street Journal, U.S. News and World Report, Business Week, Money Magazine, Financial Advisor Magazine, Investment Advisor Magazine, and Kiplinger's. Keith has been helping clients make smart financial choices for over 20 years through his comprehensive wealth management firm, Singer Wealth Management. For the solution to your financial problems, call toll-free 1-866-WEALTHY. That's 1-866-WEALTHY. And now, today's edition of Prosper with Keith Singer.
Hi, this is Keith Singer, attorney, certified financial planner, owner of Singer Wealth Management, serving Ocala, the villages, and surrounding areas. Hello, Darren. How are you?
Magnificent, Keith. Thank you very much. How are you doing?
I'm great, thank God. Glad to hear you're doing good. So we know that for several years under the Obama administration, they felt like the financial services industry needed some new rules, and pronto.
Yes.
And the Department of Labor had been working on new rules to govern the financial services industry, and in April of 2017, the Department of Labor created what is known as the fiduciary rule, or enacted, let's say, the fiduciary rule that requires registered representatives and insurance agents to act as fiduciaries when dealing with the client's retirement accounts. Some people are hoping that this rule will increase transparency, improve quality, and lower the cost of advice that's being provided by financial advisors.
I think, Keith, the rule is designed to discourage financial advisors from making recommendations based on what's good for them financially versus what's good for their clients. However, the full implementation of this rule has been delayed. The Trump administration is trying to determine the financial impact of the rule. Some people are arguing that the cost of implementing the rules could wind up being passed on to the consumers, and that the rule could preclude lower income investors from receiving sound financial advice.
Personally, I think the rule in its current form will make it cost prohibitive for advisors to service smaller accounts. From what I'm hearing, there is a possibility that substantial changes to the rule could be made prior to implementation. However, in anticipation of the rule, I think many firms and advisors have started making adjustments to reduce potential conflicts of interest with their clients. Darren, why don't you explain what a fiduciary is? Because the rule is called the fiduciary rule.
Exactly. As a noun, Keith, a fiduciary is a person that is entrusted to watch over one's assets. As an adjective, fiduciary describes a duty that requires honesty, full disclosure, loyalty, and the avoidance of undisclosed conflicts of interest. Historically, trustees, attorneys, and registered investment advisors, RIAs, have been required to act in a fiduciary capacity to their trust beneficiaries and clients. In the context of financial services, registered representatives of brokerage firms typically have not been required to act as fiduciaries. Rather, the relationship with clients has historically been that of a buyer-seller.
The buyer-seller relationship does require certain behavior of the seller. For instance, it requires the seller to avoid misrepresentations. If you go buy a car, the car salesman is trying to sell you a car at the highest possible price. And we know that, though, going in. They're not trying to give you the best possible deal. But that's okay if we know what we're dealing with, right?
Right.
The car salesman, though, isn't allowed to misrepresent facts. They can't lie about the warranty or the gas mileage. They must be honest. When dealing with the broker or insurance agent, they must also be honest and deal fairly with you. So they must recommend only what's suitable for you. That's not the same thing as being a fiduciary. They're legally allowed to sell you a product that pays them a higher commission as long as it's suitable for you.
Keith, are you saying that you should avoid this type of relationship?
Not necessarily. I'd submit there's nothing wrong with a buyer-seller relationship as long as the buyer understands the nature of the relationship. I'm sure we've all made purchases through that type of buyer-seller relationship that we're very happy with, right?
Absolutely.
Have you ever bought a car you really like?
Yes.
Well, was the car salesman your fiduciary?
No.
No, you knew that he was trying to make a buck and you negotiated and it all worked out. Same thing with a house. You're not buying a house from your fiduciary. If you know someone's trying to sell you something, you just probably need to do a little more due diligence when they're making representations and recommendations, as opposed to when you're working with a financial advisor that's held to a fiduciary standard. Investment advisors, who are usually fee-based, are bound to the fiduciary standard that was established as part of the Investment Advisors Act of 1940, which requires the advisor to put their client's interests above their own. They must avoid conflicts of interest and make only recommendations that are in the best interest of their clients. However, many registered investment advisors who are also registered representatives or insurance agents can legally act in some instances in both capacities at the same time. Unfortunately for customers, registered representatives who have recently become RIAs sometimes hold themselves out to the public as fiduciaries, even though a majority of their revenue is derived from their capacity as a registered representative or insurance agent acting under the suitability guidelines. This can be quite misleading. But no matter what the rules are, there's always a few bad apples that are only looking out for themselves. Just because one has a fiduciary duty doesn't prevent a breach of that duty. It happens all the time.
Talk about bad apples. Madoff was supposed to be acting as a fiduciary. He was legally obligated to put his client's interests instead of his own. Additionally, he was legally obligated, as we all are, not to steal other people's money. In his case, he not only breached his fiduciary duty, but he also broke the law.
So rules and laws are designed to protect us all, but they're not foolproof. When someone robs your house, there's a rule against it, right?
Of course, yeah.
But people still get their houses robbed.
Yes.
Right? So ultimately, you have to protect yourself using your own best judgment to evaluate the recommendations of your advisor.
Keith, do you think the way an advisor gets paid has an impact on their ability to provide objective advice?
It might. I mean, there's essentially three predominant ways advisors are compensated for their services. One is fee only. Fee only advisors don't accept commissions. They charge a fee that is typically based on a percentage of assets under management. Therefore, nothing they recommend and no trade that they make will result in additional compensation. This model is viewed as a good way to eliminate conflicts of interest.
This seems like the model with the least conflicts of interest. But what do we do? What do fee-only advisors do if clients want the income guarantees or safety provided by insurance products like life insurance, long-term care insurance, and annuities?
Well, the fee model isn't perfect. Fee-only advisors typically aren't experts with insurance and annuities because they generally don't work with commissionable insurance products. Moreover, if they refer those clients to insurance agents, their clients move their accounts into insurance products with protection, those fee advisors will likely lose revenue, so there are some potential conflicts. It's entirely possible those advisors might even avoid discussing the use of these products with their clients because they can't offer them. So this model, insurance products with protection, will typically be underutilized.
Then on the flip side, financial advisors who work only on commissions are incentivized to sell annuities and insurance products. That's the only way they make money.
That does happen. With commission-only insurance agents, you may see insurance products be over-recommended. And with commission-only brokers, you may see a lot more transactions than in a fee-based account. At Singer Wealth Management, we operate as fee-based advisors. We charge a fee to manage assets, and when we buy or sell investments in our managed accounts, we don't get paid extra to make extra trades or pick one investment over another. However, If our clients want guarantees offered by insurance products, either to create lifetime income or grow their funds without stock market risk, or to provide a pool of funds for long-term care expenses, we are able to offer that to our clients if that's what they need. If they only want us to manage their money, create the proper asset allocations, and do the due diligence for them on the best money managers, we're happy to do that. But if they're looking for strategies that provide safety and guarantees offered by insurance companies, we need to have expertise in that area of planning as well.
Regardless of how your advisor is compensated, each method of compensation comes with its own unique possible conflicts of interest. Therefore, you need to find someone that's trustworthy, that will make the right recommendations for your situation, regardless of how they are compensated.
Exactly. There's whatever revenue model your advisor is using, you need to pick someone who's trustworthy, that has a good reputation, that's educated, that has good credentials, that is an expert at providing advice to help you achieve your financial goals. And if you want someone that has the whole universe of products and services available that aren't just limited to money management, but also can offer products that provide lifetime income or dependability or safety, we are certainly positioned to do that for you. And if you want to avail yourself of our knowledge and our expertise, please call us at 866-WEALTHY. There's no benefit to procrastinating. If you're not confident that you're making all the right decisions, or maybe you want a second opinion, or you want us to review even one part of what you're doing, call us at 866-WEALTHY or go to our website at singerwealth.com. We're going to take a break. We'll be right back after these messages. Stay tuned.
Keith Singer would like to invite you and a guest to a lunch presentation to discuss the next big market correction and how to plan for it. This will be held on Wednesday, November 29th at 11:30 a.m. at his offices in Boca Raton. Come enjoy lunch and learn from certified financial planner Keith Singer about the potential for a major market correction and strategies that you can implement to protect yourself during the next major market correction. Space is limited, so call today, 866-WEALTHY to reserve your spot. That's 866-WEALTHY.
Okay, we are back. I want to talk a little bit about more conservative ways to manage money than just buy and hold. We've all heard the best thing to do when investing is buy and hold.
When you're looking at the historical returns of the stock market, when you're thinking long-term, big picture, clearly that's the best way to go. But what about people that aren't investing for the next 30 years, but rather the next 5 years?
Well, Darren, you just struck a nerve. Most investors know that they should be investing for the long term, yet many investors are looking at their accounts on a very short-term basis. They're looking at it every minute, every day. Perhaps, at a minimum on a weekly or daily basis. And they're making adjustments based on what's happening in the short term. There's 5% pullbacks all the time, although there hasn't been for a while, but that people generally overreact to those. And like I said, we haven't had one of those since right before the election.
Most investment professionals would agree that stock market declines in the 0 to 5% range is just ordinary market movement or statistical noise. After this, there are 3 types of market declines that are simply distinguished by their size. A pullback is a 5 to 10% decline. A correction is a 10 to 20% drop. And a bear market is a drop of more than 20%.
Generally, pullbacks should be ignored.
Yes. If you try to get out of the market during a routine pullback, you could get whipsawed and miss the rebound and seriously underperform the market.
So by whipsaw, you mean the market goes down, you sell, and then it comes right back up, and then you get back in. And you basically locked in your losses, and now you missed the rebound. So, as you said, pullbacks are not something you might want to react to. You might want to ignore pullbacks. They happen all the time. 5 to 10% pullbacks are very common in the equity markets. During the cyclical bull markets since World War II, according to Yahoo Finance, there have been 98 pullbacks, 13 during the 1990s bull, and 12 during the 2002 to 2007 bull market, and 17 during the current bull market. On average, there have been 3 pullbacks each bull market year, and in the 2009 to 2016 period, that was no exception. Since the election, the U.S. equity markets have enjoyed very low volatility and no pullbacks greater than 3.3%.
Typically, the financial media hypes pullbacks as fear is good for ratings.
The financial media obviously needs ratings. They like ratings. They want to broadcast what gets them ratings. And the potential market crash is something that everyone tunes into because they want to know if they're about to lose a bunch of money. But again, pullbacks are very normal, and we recommend you simply ignore them. Now, if you can't handle a 10% decline in your account value, you might want to reconsider whether you even belong in equities at all. I'm very serious about that. If you can't stomach the thought of seeing your account lose 10%, you really shouldn't be invested in stocks. Over the last decade, reacting to pullbacks has helped cause or contributed largely to the underperformance and even the undoing of many tactical managers. It's very difficult for even a professional tactical manager to successfully avoid an ordinary 5 to 10% pullbacks and provide timely reinvestment without being subject to whipsaw. As we mentioned earlier, whipsaw occurs when the price of a security heads in one direction, but is quickly followed by a movement in the opposite direction. The terms originated from the push and pull action used by two lumberjacks to saw wood with a large two-handed saw.
Good analogy.
Let's say we are experiencing a pullback that will bottom at the historical average of 7%, -7. That's the historical average of pullbacks. The first 5% decline gives us the alert that, hey, the market's in a pullback. And then the strategy only has between -5 and -7 of additional decline to react to sell that strategy in order to avoid any of the pullback. And if you successfully get out of the market before the bottom, then you have less than 1 to 2% of the initial recovery to reinvest without recovering a loss. So, in other words, if the market goes down 5 and you sell and then it goes down to 7, but you don't get back in until it's back up to -2 from where you started, your in and out hurt you. So it's very hard to get in and out on a pullback and make it be profitable. Now, most pullbacks have lasted just a week or two, so often merely within a few days. It's probably unrealistic that any strategy can correctly sell and buy back in such a narrow window. An attempt to achieve this increases the likelihood of the whipsaw, as we mentioned. Again, we don't want to lock in the loss and miss the rebound, which is often much greater than the loss. The manager, if they have just stay invested and don't react to pullbacks, the net gain is realized and all the trading costs have been eliminated. If you apply to a scenario, to a strategy that employs leverage, options or shorting in your tactical management, it only exacerbates the situation and can make the reaction windows even smaller. If the price action is less than 10%, the best course of action, obviously, in retrospect, would be to have ignored the pullback, whether in a single position or the market as a whole.
Keith, it seems like a lot of times that when the market exceeds a 10% loss, that all bets are off. And many times it goes down a lot more.
Darren, you're actually onto something. Based on the historical data back to World War II, an interesting phenomenon occurs when we exceed a 10% pullback and delve into a correction. The average loss actually doubles, and the average length of time almost quadruples. The realities of investment math begin to have a greater effect as the larger a loss a portfolio sustains. The harder the remaining capital has to work just to break even. So when you have a big loss, you have to make a lot of money just to break even. Between a 10 and 15% decline, some tactical managers believe that that's the time to evaluate the situation and look to sell the weakest positions in a portfolio, even if it means raising cash. Furthermore, when these types of corrections are occurring, no one knows how far they will go.
I've seen research that indicates that corrections turn into bear markets a decent percentage of the time. We actually work closely with some tactical money managers that uses a rule-based investment system to try to avoid the big corrections and bear markets. A tactical manager like this could be good for more conservative investors who are interested in growth strategies with defensive capabilities. Stock markets are cyclical and are subject to frequent moves of plus or minus 10%. Since pullbacks occur with frequency and consistency, tactical strategies that avoid reacting to pullbacks probably have a distinct advantage. In fact, not reacting to common pullbacks in bull markets has proven to be the better course of action from a performance, turnover, and expense standpoint since 1946. It is not the ordinary pullbacks that devastate a portfolio. It is the large losses found in corrections or bear markets that hinder long-term success.
Very insightful. I like what you said, that the tactical managers that probably you want to consider are using some sort of rules, right? They buy in a certain condition, they sell in a certain condition. They're not using emotions. They're not using a gut instinct. I think that's very unreliable to rely on someone with a gut instinct. But then, if it's so hard to be successful, why not just be a buy and hold investor?
Keith, I would submit that if we're in a complete vacuum, if the investor has no emotions, an unlimited time frame, vast wealth, and or no need for the money, then yes, historically it makes sense to buy and hold. Yet, as every advisor knows, this most often is not the case. Dalbar proves this every year in their annual investor behavior report, where they show how the average investor only receives about 1/3 of the market's return over time. Why? Humans are emotional. We invest to improve our futures. Corrections and bear markets elicit fear that our futures will be irreparably harmed, or that a major goal may be destroyed or significantly delayed. It makes sense that investors react, but doing so too soon, as outlined above, is even more harmful. Investors driven by human emotion cannot help themselves, and they sell at the worst possible times. Investors and advisors can definitely benefit from growth strategies that can make the buy and sell decisions for them using a rules-based system. Remove emotion from the investment process. Smooth the investor experience by embracing our clients' humanity and acknowledging how they feel and act. In short, deliver what investors need and deliver what investors expect.
Well, that would be nice if we can get all of that, and that's a nice philosophy, and that is our philosophy. But there actually are money managers out there who have tactical strategies that seem to greatly reduce the downside risk. And when you're evaluating a tactical manager, obviously they all have their secret sauce. They have certain rules that they follow, when to buy, when to sell, certain philosophies, like don't react too early if the market just has an ordinary pullback, only when it's something more major, start to take defensive action. But what you want to look at is, historically, what is your maximum drawdown? Maximum drawdown is a phrase used in the industry that describes what is the most you lost in a portfolio from the highest point to the lowest point. Let's say for instance, for a lot of managers, it was from beginning of 2008 until March of 2009, right? During that big bear market we had in 2008.
That's correct.
And if you look from the highest point to the lowest point, I think the S&P, although it was down 37% in 2008, the largest drawdown it had from the highest point to the lowest point was, I think, 51% or 53%.
That's right.
So that means that if you had $1 million at your high point, you're feeling happy, and you're looking at your account statement, and then a year later, or however long it was till the lowest point was reached, you only have $490,000, and that can be really painful. So there's a couple tactical managers that we have some of our clients' money with if they want to try to still be in equities but take less risk. And some of them are sector rotations, where as one sector of the market starts doing poorly, they get out and they go into other sectors that are doing less poorly. And if need be, they go fully into cash. And so most money managers aren't tactical. They won't go into cash. They're buy and hold. They're meant to be buy and hold. And advisors utilize them as the buy and hold segment of their strategy. But there are some tactical managers out there that are worth a look, that, again, you want to look at what's the worst drawdown you ever had. And we have some tactical managers where the S&P's biggest drawdown was -51 and their biggest drawdown was -8.
That's
right?
Pretty good.
So most people can live with that kind of loss.
I could.
If they're and this manager happens to be beating the S&P 500 with less risk. So that's sort of our philosophy in almost every area, from the money management to the alternatives that we recommend to clients. How do we get the best returns with the least risk possible? We have some strategies that have no market risk and no interest rate risk, like modified endowment contracts. We have some tactical managers that will try to mitigate any downside possibilities, that have done that successfully. So if you want to look for more conservative ways, not for less returns, but for the same types of returns you're getting, or maybe even better with less risk, we're the people to call. Call us at 866-WEALTHY. If you all you have is a buy and hold portfolio, and maybe you're trying to reduce the risk by having a lot of bonds and cash, that's not the most efficient way to reduce risk, because that part of your portfolio probably isn't going to make much money. So you're giving up a lot of returns to try to reduce your risk. And even the stock part of your portfolio still has the full risk. So if you want to reach us, call us at 866-WEALTHY. We'd be happy to review your portfolio, or go to our website at singerwealth.com. We're going to take a break. We'll be right back after these messages.
Keith Singer would like to invite you and a guest to a lunch presentation to discuss the next big market correction and how to plan for it. This will be held on Wednesday, November 29th at 11:30 a.m. at his offices in Boca Raton. Come enjoy lunch and learn from certified financial planner Keith Singer about the potential for a major market correction and strategies that you can implement to protect yourself during the next major market correction. Space is limited, so call today, 866-WEALTHY, to reserve your spot. That's 866-WEALTHY.
Hey, it's Sean Hannity here. Do not touch that radio dial. You are listening to Prosper with Keith Singer.
Okay, we are back. This is Keith Singer, owner of Singer Wealth Management, attorney in the state of Florida, also a certified financial planner with offices and meeting places in West Palm Beach, in Boca Raton, Fort Lauderdale, and Miami. Happy to meet you. Call us at 866-WEALTHY if you'd like to speak with us or meet with us. Darren, according to the Insured Retirement Institute, for each of the last 2 years, investors looking to avoid stock market risk have put over $200 billion into index annuities. While these products are designed to protect investors' principals, different offerings may vary differently from product to product in terms of growth potential. Unfortunately, many insurance agents do not accurately depict how the products work. I have a list of areas I feel advisors need to do a better job of explaining. Let's talk about fees. Especially with variable annuities. What's the biggest knock you hear from people regarding variable annuities?
A lot of variable annuities have high fees, which can be a drag on performance, Keith.
Okay, well, that's true for many variable annuities, but not necessarily all, right?
Right.
Last week, we reviewed a listener's variable annuity, and we called the company, and they told us he was paying over 5% per year in fees.
Ouch.
He had no idea, and he was very upset. However, not all variable annuities are expensive. I would ignore any advice which states never buy a variable annuity. I would change the advice to be skeptical of any variable annuity with high fees, right?
Right.
There's some good variable annuities with low fees, and there are several reasons why an investment in a low-cost variable annuity may be beneficial.
Keith, obviously tax deferral is big. You can switch from one professionally managed sub-account to another without any tax consequences. So if you have profits and you want to get more conservative within that annuity, it doesn't trigger any tax liability to reallocate.
That's important.
Incredibly important. Secondly, a lot of people want to create guaranteed lifetime income streams regardless of what happens to their investments. There are some big name insurance companies that are now offering income riders with very low fees that can make a lot of sense if you need income. And the levels of guaranteed income being offered are surprisingly high.
That's true. We just saw a new product, and we were actually quite impressed with how high the guaranteed income is. It's much higher than almost any other product I'd seen in the last year. So these things are always changing. The other main benefits of variable annuities are protection. You just mentioned the protection from running out of income, but there's also other forms of protection. For instance, under Florida law, variable annuities are protected from the claims of creditors, as are all types of annuities. That means that if someone sues you, they can't take your annuities to satisfy their claim. There's no limit either to this level of protection. You could have $100 million in annuities, get sued for something, and they can't take your money away. Secondly, most variable annuities guarantee your principal at your death. You can also own a variable annuity that guarantees up to a 7% death benefit.
That's a great deal if you don't think you have a long life expectancy. Let's say you're dealing with medical issues. If you were to pass away in a few years or less, there is no guarantee that your investment accounts will have gone up over the prior few years. In fact, consider what the value would be if you passed away shortly after a recent correction or even a bear market. The value of your investment accounts could have dropped considerably. However, think about this. What if you had a minimum 7% guaranteed death benefit? If the market did well, your heirs get the full upside, the full account value. But if there was some bad luck and the markets did poorly the last few years, your heirs would get your full account value growing at 7% per year, whichever is higher. If you are managing your money, knowing that is going to your spouse or kids, why not create a minimum 7% return?
Very true, Darren. The insurance company is actually taking a big risk here because there's no medical underwriting. With life insurance, if you want to buy a life insurance policy to insure against you not living long enough, right? And you have medical conditions that's creating a short life expectancy for you, then you're uninsurable. No one's going to give you life insurance. This strategy is actually similar when you invest. You're investing with the notion that what if I pass away and I haven't had time for my investment to recover from a correction? What if I didn't live long enough? There's no underwriting on this. Everyone qualifies. If I was running an insurance company, I'd not offer this product to people that are in poor health because it's just too risky. If someone has a short life expectancy, we have no idea if the market's going to be higher or lower in a year or two, right?
That's correct.
In 10 or 20 years, we know it's going to be higher. But in a year or two or three, who knows? But luckily, there currently is no requirement that one be in good health to qualify. So if you're managing money that will eventually go to your spouse or your children, and you want to create a minimum 7% death benefit, call us at 866-WEALTHY. I have a client who has cancer, and he put a large sum of money in a variable annuity with a 5% minimum death benefit. And what that did is, knowing that he had that minimum 5% death benefit, and that this money was going to go to his spouse or his kids, that it enabled us to invest aggressively. And therefore, the first year, his account was up 18% in the last year. And so what happens is that becomes his new death benefit. His highest anniversary became his new death benefit. So now he's locked that 18% in. So if the market subsequently crashes, his gains are locked in. Hopefully he recovers and lives a long life. But either way, his family is guaranteed to get a lot more money than what he put in.
Peace of mind. What I'm really excited about are a new type of annuity called buffer annuities. The client gets to pick an index like the S&P 500 index or Russell 2000, and they also get to pick the buffer amount. A buffer amount could be 10% to 25%. This is the amount of loss that the insurance company will absorb on your behalf. So if the buffer amount is 10% and the index value is down 12%, you only lose 2%. Or if the buffer amount is 20% and the index is down 15%, you don't lose anything. Furthermore, these products don't charge fees. Instead, they have a cap. So on a 6-year product, if the cap is 85% and the index was up 75%, you make the entire 75% with no fees. However, if over 6 years the index was up 90%, you only make 85%, not the 90%.
So, for instance, if you put $100,000 into something and there was a 85% cap, and after 6 years the index had gone up 90%, ordinarily, had you invested in the index, your $100,000 would be worth $190,000.
Correct.
But in this case, because you're capped out, it's only worth $185,000.
That's still pretty good.
It costs you 5% over 6 years, which most people aren't upset paying a fee if they made good money.
No, it's 5% for protecting your money is incredible.
If you made average money, you don't pay any fee.
Yeah.
If you made low money, you don't pay any fee. And if you lose money, the company absorbs some of the loss. So essentially, with this method, there's no fees and downside protection. But if the index goes up a lot, the investor makes a very good amount of interest, but perhaps not quite as much as the index itself. So if you're trading some potential upside to reduce the downside, it's very compelling. If you can appreciate the value in hearing about new low-cost innovative strategies, please call us right now at 866-WEALTHY. So that's variable annuities. Let's talk a little bit about index annuities. One of the things that I'm hearing a lot from index annuities are guaranteed returns of 5, 6, 7%. You know, I cringe when I hear people promise prospective clients returns of 5, 6, or 7% on an index annuity, Because if there were products that were offering a guaranteed return on your money of 5 to 7%, wouldn't we be talking about that?
Absolutely would be talking about that.
I'd be saying, hey, there's a guaranteed 7%, come get it. But there are currently no insurance companies offering high guaranteed returns on your money when the 30-year treasury is under 3%, right? So what are you hearing then when you hear guaranteed returns of 5, 6, or 7%? It's many of these index annuity products offer an income rider. Sometimes it's included. Sometimes there's an additional cost for it. But an income rider allows you to withdraw a certain amount of money from your account each year without fear of running out of income. Because even if you deplete your account, the income will continue as long as you live. This might give you some peace of mind, but it's not giving you a guaranteed return of 5 to 6 or 7%. The amount of the income value may increase by 7% each year, but that's not a return on your money. There's never a time when you can cash out the income value or the income rider value. So what are you actually getting? Let's say you put $100,000 in and you get a 7% income rider, and after 4 years, now your $100,000 is $128,000. Maybe you were 70 when you started. Now you're 75, and now you can take out 5% a year of $128,000 without running out of money. Well, what is that? A little over $6,000 a year. So you have to live another 15, 16 years before you've depleted your account anyway. You got to live to 90. So if you live to 95, you wound up taking an extra $30,000 out more than you put in, at least based on the income rider value. So your income rider value actually doesn't necessarily even guarantee you a positive return if you don't live that long. If you don't live that long, it doesn't guarantee you anything. Plus, if you're paying 1% a fee for that rider, you're actually losing value from your account value. So if you're under the impression that the annuity you own or are considering is paying you a guaranteed return of 5 to 7%, please call me and I'll show you exactly how your income rider works. By the way, I'm not a big proponent, at least right now, of what I see being offered, of using income riders on index annuities. The insurance companies charge you, like we mentioned, roughly an extra 1% interest. And in my experience, many people don't wind up using them. And of those that do, only a few are most of them are spending their own money. Most of them are spending their own money. Very few of them are projected to live long enough to use up all of their own money so that they actually receive a benefit from the insurance company. So the insurance company, in order to get your business, Darren, they got to do one of two things, right? They either got to give you the appearance of value or actual value.
The actual value, correct.
Right? And it's a lot cheaper for them to give the appearance of value.
Absolutely, the appearance.
What's another way that they give the appearance of value?
Bonuses.
Right? A nice big bonus?
Yeah, of course.
To entice you to come put your money with them. Now, obviously, most of their clients aren't first-round draft picks or the top of their class
They wish.
at Harvard Law.
Right.
So there's not a signing bonus they're getting based on merit. It's based on marketing.
Correct.
So when you look at a product, a bonus could be good, but most likely it's window dressing for an inferior chassis that's underneath it. What you want to consider is, for the 5 or 10 years you're going to own the annuity, what's going to give you the most benefit over that term, not the first year, right? Because you have 9 years left that you got to worry about, not just the first year bonus.
That is correct.
So if you want to explore the safety of an index annuity and potentially make 5 or 6 or 7%, not guaranteed, but projected based on the way they credit interest. There are some index annuities where we feel there's a really good chance to make 5 to 7% without any stock market risk. If you want to try to make a decent, respectable level of return without having to worry if the market crashes or not, call us at 866-WEALTHY or go to our website at singerwealth.com. I've been doing this for over 20 years. You've been doing this for what, over 25?
Yeah, almost 30 years.
We think we know what we're talking about by this point, hopefully.
We do.
And, we're in the prime of our careers. We have another 20, 30 years to work with you and your families, but we're not fresh and green off the turnip truck where we don't know what we're doing either, right? So
we want to help you, though. That's the biggest thing.
We want to help you achieve your financial goals. We want to help you get what you want to get. Call us at 866-WEALTHY. And we'd be happy to speak with you or meet with you. There's no point in procrastinating, is there?
No, please don't procrastinate.
We'll be right back. We'll talk to you after these messages.
Keith Singer would like to invite you and a guest to a lunch presentation to discuss the next big market correction and how to plan for it. This will be held on Wednesday, November 29th at 11:30 a.m. at his offices in Boca Raton. Come enjoy lunch and learn from certified financial planner Keith Singer about the potential for a major market correction and strategies that you can implement to protect yourself during the next major market correction. Space is limited, so call today, 866-WEALTHY, to reserve your spot. That's 866-WEALTHY.
Hey, it's Kevin O'Leary, Mr. Wonderful from Shark Tank. You're listening to Prosper with Keith Singer. Don't turn that radio off. We've got good info for you.
Okay, we are back. Hi, this is Keith Singer, attorney, certified financial planner, owner of Singer Wealth Management, serving Ocala, the villages, and surrounding areas. There are ways to pass on risk to insurance companies. You can pass on risk to the insurance company of dying too soon. You can pass on risk of the insurance company of living too long. And you can also pass on inflation risk. Right now, there are people out there that have money in the bank or invested very, very conservatively that they're making next to nothing. Used to be when your money was in the bank, you made 5%, 6%, 8% even. But those days are long gone and they may not ever come back. So a lot of people are waiting for those days to come back, but I don't think they're coming back. So each month, each year, each decade, while your money sits in the bank, it has losing buying power to inflation because every year you're going to need to have more money to buy what you needed each year, right? So if you need $100,000 to live this year, to buy all the things you want to buy, to go out to dinner, to pay your rent, you're going to need $102,000 next year, and you're going to need $104,000 the year after that. So if your money isn't growing, it's losing buying power. And fortunately, there are insurance products that you can invest in that will allow you to make more money than inflation and actually exceed inflation. And they come in a variety of shapes and sizes, but the general theme is that you can put your money with insurance companies and they'll pay you interest without stock market risk, without interest rate risk. And the strategies that we've helped so many clients with to do that for people that would have otherwise had money in the bank making next to nothing are specially designed modified endowment contracts. They're not the kind of modified endowment contracts you would get if you're just looking to pass money on to your heirs. Traditionally, that's why people bought modified endowment contracts, to grow money tax-free for their heirs. We're able to specially design modified endowment contracts so that they can actually be a proxy to the cash in the bank that you might have. Because we're able to design these contracts where they're liquid. There's no upfront load to get in. Most modified endowment contracts have an upfront charge and a back-end surrender charge. So if you put $100,000 in and you want your money back in a year, you might only get back $90,000. But that's not how we're designing them. We're designing them so that if you put $100,000 in and you want your money back in the year, you're going to get at least $101,000. But if the stock market goes up, you might have $110,000, right? So the way that you get interest is one of two ways. Either you get the minimum interest of 2.5% currently, or you get what the S&P 500 gets. Whatever's higher, that's what you get. If the S&P 500 went up 6%, you made 6%. If it went up 10%, you made 10%. That's available right now. And so historically, if the market goes up in the up years and you made 10% even, and in the down years you didn't lose, you're going to average 6 to 7%. Now, there are some insurance costs, 1 to 1.5%, but if you know you're guaranteed a minimum of 2.5%, you're going to make at least 1%, with the probability of averaging 5 to 6% after all fees and costs. No stock market risk, no interest rate risk. If you went to the bank and they said, we have a savings account that's paying 0.2, we have a 1-year CD that's paying 1, let's say, or we have another account that's going to pay a minimum of 1 and a maximum of 10, would you put any money in the first two accounts? Of course not. And that's what we're talking about here. We're talking about the ability to make at least what you're making in the bank or in a 1-year CD without having to tie up your money, with the probability that historically every 2 out of 3 years is up and every 1 out of 3 years is down. So if you hold it 3 years, you're probably going to make 18 to 20%, 22%, whatever. And if you hold it 10 years, in a great decade, you'll make 80%. In a bad decade, you'll make 60%, 6 to 8%, and you'll get that money each year. We have clients that have come into our office with large amounts of money in the bank that said, I don't want to risk it, that have made double-digit returns 2 years in a row on money that they would have made less than 1% on. So clearly they were happy that they met us. Clearly they were happy that they got some of our ideas. There's other ideas we gave them that also worked out well. But that's what we do. We try to find strategies that work out the best for our clients. Because if our clients get good results, then we get referrals and our business does well. So that's our business model. Do well for clients so that our business will grow. Now there's people out there that are short-sighted, that rip off clients and put them in bad things because they're only concerned about tomorrow, but we're concerned about now and 10 years from now and 20 years from now, making sure that everyone's happy, all of our clients are happy, and things work out well. And that's our philosophy. So as regarding this strategy, people say, well, how can you make so much interest on something that's so liquid? Now, clearly, if you go to the bank and your money is liquid and you can take it out tomorrow, you're not going to make any interest. If you said to the bank, here, hold my money for 20 years, they're going to pay you more interest, right? The longer they hold your money, the more that they can pay you. That's just the way it works. Well, with modified endowment contracts, according to their experience, most people aren't taking the money out because of the taxes. If they take the money out, they have to pay taxes. So if you gave $1 million to an insurance company and now after a year you have $1.1 million and you say, I want to cash out and do something else, well, you're going to have to pay taxes, right? So your $1.1 million is going to go down to $1.06 million after you pay your taxes. Now that $1.06 million would have to be in something else that's going to grow better than your modified endowment contract that has $1.1 million in it. Right? So most people aren't taking the money out. And if they never take the money out, they never pay taxes. Now, people don't like to be told you can't take your money out or there's a charge to take your money out. So the insurance company realized if we don't tell them that and give them that choice, more people will put money in and it'll be better for everyone. But from an experience standpoint, the insurance company believes that they're going to have your money for a long time and they're able to pay you more interest as if you were locked in. You're not locked in, but if you were locked in, they could pay you more interest. But they're treating you with returns as if you were locked in, even though you're not, because they know from their experience, most people are going to keep the money there. When you think about required minimum distributions of IRAs, most people never take out money until they have to. They never want to take out money because they have to pay taxes, and therefore the government actually makes you take money out. So imagine if IRAs were tax-free at death and there were no RMDs. No one would ever take money out of our IRAs. They would leave it for their kids. They would spend other money. Why spend money if you take it out and you pay taxes, and if you don't take it out, you never pay taxes? People like to be logical. People like to be efficient. And so when we work with our clients, if they need money to live or for income, we'll create it for them in the most tax-efficient way. And if they've made good money in their modified endowment contract, typically taking it out of that isn't the most tax-efficient way, and we'll get it from somewhere else. So when we meet with someone, we're going to plan for income. We're going to plan for emergency money. Now, if someone needed the money and that's all they had, go ahead, spend it. No problem. You got to pay taxes. But if that's the case, you might not be in a high tax bracket anyway. So we're able to design these contracts that are liquid, where you can make expected returns of 5 to 6%. You're not guaranteed to make 5 to 6, but you're guaranteed to make at least 1 after fees and costs. And you're guaranteed to have a tax-free death benefit depending on your age. That could be twice what you put in. And that's also a long-term care benefit. You know, a lot of people don't like paying for long-term care. What if they never needed it? This is a long-term care benefit that if you never needed it, it's going to go to your heirs tax-free. And if you need it, it's going to go to you tax-free, right? If you can't do 2 out of 6 activities of daily living, they let you take out that death benefit that's twice what you put in or 3 times what you put in, depending on your age, while you're alive. So this does so many things. It's helped so many of our clients be more efficient and combat inflation when they otherwise would have been losing buying power. So if you are tired of losing buying power, or maybe you have money in the stock market that you don't want to risk, or maybe you've recently got out of the stock market because you think it's too high, and you want to make money when the market goes up, that's why you've invested, but you just don't want to lose the next time it goes down, we can do that for you, because that's how these things work. And you might say, well, I'm giving up a lot of upside, but you're giving up all the downside. Right? So think about that. You make money when it goes up. You don't lose when it goes down. If you look back at the last 15 years since 2000, you would have done better having an 11% cap and no downside risk each year than actually be invested in the market over the last 15 years. You actually would have made more money than actually being in the S&P 500. Not to mention the fact that so many people who actually invest in the market make bad decisions, pay a lot of fees. They get in when the market's done well. They get out after it's gone down, and they miss rebounds. Studies show that. So most people don't even make what the S&P 500 made. But if you could have had no risk and over the last 15 years actually made more than the S&P 500, that's compelling in our opinion. That's what we're looking for. We're looking for ways where you can make decent returns without fear of loss, without risking anything, without the stress or the worry or the anxiety that comes with it. So that's why people are in the bank, because they don't want the stress or the worry. They don't want to lose money. So what I'm saying to you is we've developed a strategy that can get you a very good return, very attractive return, 5 to 6%. You're not going to break the bank, but you're not going to lose. You're not going to have worry. You're not going to have stress. And if the market winds up doing amazing the next 10 years, then you would have been better off being in the market. But if it has a big down year or a couple big down years, then you would have been better off being in this, not only from a peace of mind standpoint, but from an actual dollar standpoint. So there's no reason to procrastinate. If you've been listening to me talk about this for the last few years, and your neighbors have been making money in their safe investments without tying it up, and you've just been sitting there making nothing in the bank, or you want to take less risk, give us a call at 866-WEALTHY or go to our website at singerwealth.com. We'd love to chat with you. We can send you a free report. We can meet with you. We can design something exactly for your needs, for your situation. Call us at 866-WEALTHY. Don't procrastinate. It never pays to procrastinate. Call me. Looking forward to hearing from you.
This is Mario Gabelli. You've been listening to Prosper with Keith Singer.
You have been listening to Prosper with Keith Singer. For the solution to your financial problems, call toll-free 1-866-WEALTHY. That's 1-866-WEALTHY. And tune in again at this same time for Prosper with Keith Singer.
Keith Singer is registered with and securities offered through Investacor, member FINRA SIPC. Investment advisory services offered through Singer Wealth Advisors, Singer Wealth Management, and Singer Wealth Advisors are not affiliated with Investacor. The opinions and recommendations contained in this broadcast are those of Keith Singer and Singer Wealth Management and not of Investacor. Past performance is not a guarantee of future performance. Upon liquidation, your investment may be worth more or less than its original cost. The investments discussed may be suitable for only some investors.
The opinions expressed on the preceding sponsored program were strictly those of its hosts, guests, and callers, and not necessarily those of this station, its staff, management, or sponsors.
The City of Ocala Department of Recreation and Parks are proud to present the 34th Annual Light Up Ocala on November 18th. The fun starts on the square in downtown Ocala from 4 to 9 p.m. There'll be food vendors, 4 stages of entertainment, Whoville, Theme Kids Zone, the Downtown Holiday Skating Rink, crafts, the Junior Sunshine Christmas Parade around the square, and at about 7:30 p.m., the official Downtown Lighting Ceremony.
Fox News Radio, I'm Chris Foster. Neighbors say he'd been shooting off guns day and night, and the mother of a man who shot 14 people, killing 4 in Northern California, says he'd called her the day before to say it's all over now. Kevin Neal was shot and killed